Okay, so good afternoon, everyone. It's a pleasure to join you in sunny Cannes today. My name is Alex Murray, and I'm Vice President in Preqin's Research Insights team based in London. I predominantly cover infrastructure as an asset class, and I'll quickly take us through a few headlines from our recent Global Infrastructure Report, which we released in December. You can access these slides through using the QR code on the slide here, and I'll also show that at the end so you get a chance to scan that. The report that a lot of this analysis comes from is available with an Insights Plus subscription, so please do join us at the booth for a platform demo and to discuss how you can access this report and other research. So to set the scene, I've included some results from our November 2022 investor survey here, and we saw this morning about sentiment around concern around increasing interest rates. These responses are to some slightly different questions. So investors' views on where we are in the business cycle seem to be coalescing between starting to decline and approaching the bottom, with the equity market a little further along, as you can see from the chart on the left here. Only the commodity markets are considered to be experiencing better times. And there's some spillover from that into infrastructure via many funds' exposure to increasing energy prices. Excuse me. The increasing pessimism about the near-term trajectory of the wider economy is central to strategic decisions for the next 18 months, regardless of whether central banks can tame inflation. LP's views on the fair value of asset prices show somewhat moderation to normal levels after November 2021 responses suggested they'd become particularly overheated. However, in wider polling, managers take a slightly more pessimistic view, with 46% responding that they think assets remain overvalued, with room left for further price reductions. Given managers are a little closer to the deals market, these views together suggest we can expect some downward adjustments in the anticipated recession. Moving on to slightly rosier numbers, 2022 has been infrastructure's most active year for fundraising by far. Fundraising in the first 6 months of 2022 was frantic, but slowed in Q3 to deliver $130 billion raised over the first 9 months of the year. That's versus $129 billion over the full year in 2021. What has driven a lot of this activity? Well, it's clear if you look at the geographic target of the aggregate capital raised here on the right, that President Biden's legislative program is certainly one major driver. So of the capital raised to Q3, 68% was done so by funds with a North American focus. And that's averaged about 42% between 2011 and 2021. So it's a really standout year for those North America focused funds. The Infrastructure Investment and Jobs Act of 2021 and the Inflation Reduction Act in 2022 combined to provide circa $1.6 trillion of funding over the long term, over about 10 years. But their signal for investment is as influential as the direct funding that they'll facilitate. Despite this standout year, we expect fundraising will temper back to trend. Provisional Q4 data suggests that there's a much more subdued second half of the year. Further, the denominator effect will slow investors' efforts to reach target allocations. Look out for the latest infrastructure fundraising numbers in our Q4 update at the end of January. So, energy has always been at the center of the unlisted infrastructure asset class, and looking at the long-term deals data that we have at Preqin on the left here reveals how the sector's share of deals by number has steadily increased from below 40% in 2006 to above 60% in recent years. Renewables deals have driven this, although despite their growing total in terms of number of deals, they typically absorb less capital than conventional energy deals because they're usually smaller in scale. Recent events have demanded a rethink about the energy transition, forcing us to acknowledge we cannot simply substitute carbon-intensive conventional energy with renewables. The intermittency of renewables and insufficient energy storage currently leaves grids exposed, threatening the reliability of supply. Renewables fundraising in the last few years has risen dramatically, as we can see on the chart on the right here. So 2020 saw the aggregate capital raised by renewables-focused funds rise by 69% to $60 billion and has remained at this level since. Around half of all fundraising in the asset class has gone into such funds. However, renewables are currently being impacted by a political and regulatory backlash on the excess profits of energy generators, and that could curtail upsides in the future. Governments are conscious, though, of the need not to stem the flow of investment or risk failing to deliver on longer-term energy security policy ambitions. So, as construction material costs have soared in the last 18 months or so, many contractors within supply chains who signed fixed-price contracts will have been forced to renegotiate or face insolvency from absorbing huge increases in the cost of basic materials. US PPI for building materials and supplies dealers was up by 55 points from 153 in January 2020 to 208 as of September 2022. Here on the left, we have some data for the UK that suggests the greatest price increases have been in aggregates and insulation. So rebar steel and precast concrete have also climbed by around 30% and 27% in the year to September 2022. Both are obviously key inputs in developing out primary investments in greenfield infrastructure assets. Beneath the downward trend in the number of infrastructure deals being done lies a shift in the type of deals. The share taken by primary deals, including both greenfield and brownfield, has declined from 52% in 2010 to just 41% in the first 3 quarters of 2022. Looking at this from an aggregate deal value perspective reveals a starker trend, though. As we can see from the chart on the right here, primary deals have reduced from 55% in terms of aggregate value in 2010 to just 27% up to Q3 2022. So secondaries are really coming to the fore. The drivers behind this shift are manifold. So one includes the desire for managers to invest and investors to avoid the J-curve, and they can do that through purchasing steady-state operational assets via secondary deals. But this is also part of a maturation of the unlisted infrastructure asset class. It's a natural consequence for asset classes to, over time, become more dominated by secondary deals. Another driver, more relevant in recent years, includes the challenges of getting assets built on time and to budget. This is a necessity for an asset class whose values proposition relies on stable cash yields and no surprises. We suggest that the challenges of supply chains to deliver primary investments without cost escalations will further push investors towards secondary assets. As J-curves deepen, managers may struggle to sell the low volatility angle without a stable long-term revenue model. Turning to our recent survey data here, we can see on the left that the proportion of investors reporting that they will commit less capital has increased from 11% in November 2021 to 18% in 2022. So that's the blue section at the top of the bars on the left. So this is no surprise considering the record-breaking volumes of capital raised in the asset class during 2022. A cooling of investor appetite was inevitable, but there will also be some of that denominator effect they're working through, especially for LPs that are close to or at their target allocations. Of slightly more concern is the change in their longer-term intentions for allocations. So in 2022, the highest proportion of investors since polling began in 2017 suggest they will reduce long-term allocations to infrastructure at 11%. And that's the first double-digit percentage result we've seen in this asset class. However, on the other side, a record share of investors say they will increase long-term allocations at 58%. Clearly, there is diversity across the infrastructure asset base in terms of target allocations and current exposure to the asset class. So to wrap up, there are three overarching themes which emerged from the research behind this year's report. Firstly, it's hard to ignore the signal in the fundraising data in relation to the shift in geographic focus over 2022. It was a clear standout year for North America-focused funds, which raised 68% of capital to Q3. Biden's Infrastructure Investment Act in 2021 and the Inflation Reduction Act in 2022 go a long way to explaining this jump, and we've had discussion of that legislation this morning in other sessions. This commitment from the US to the energy transition has been applauded at Davos. However, we've seen in Europe more recently a look to counter this agenda with discussions around continued relaxation of state aid rules. This could have major implications for infrastructure funding and financing in the region over the coming years, and questions remain over whether the EU can legislate quickly enough to prevent capital and skills flowing to the US. The second theme was the impacts of inflation, stemming from the challenges of turning supply chains back on after widespread global lockdowns. The start-stop nature of restrictions on work and movement left many global trading networks unable to function, with ongoing questions about demand and revenues undermining investment. Labor, equipment, and materials have all been affected, making primary asset development far more challenging and costly than before 2020. And finally, and somewhat related to the previous point, global oil prices have returned to pre-2014 levels, with wholesale electricity prices in Europe rising accordingly. However, not all infrastructure generators will benefit if they've adopted very risk-conservative offtake structures. Many merchant power developers, on the other hand, will be reaping the full upsides of these higher prices, especially because the low marginal cost renewables developers will have seen greater growth in their free cash flows because they've avoided the price effects on the cost side of their business. However, this has prompted, as mentioned, both political and regulatory reactions, which will bite in some markets. Managers can use this to anticipate where regulation will be tighter and pick their markets a lot more strategically. So you've seen a range of analyses based on Preqin data. We are a leading provider of data in alternatives, including in recent years our new ESG metrics. We've just launched a comprehensive view of the potential sources of ESG risk and impact in over 32,000 infrastructure assets. So that's it from me. Thank you very much for your time. You can use this QR code here to access these slides. We'll have our Q4 quarterly market updates out at the end of January for all of the alternative asset classes, so look out for those. As a reminder, Preqin has a booth at which we'd be keen to demo our platform, as well as provide access to some of our research and insights. You can find us on the Green Lounge in Space 4 on level 0. I will be available for a Meet the Expert session tomorrow morning from around 10:30 till 12 midday before lunch, so feel free to pop by. I'm particularly keen to discuss with people the prospects of an EU version of the US Inflation Reduction Act and how that might pan out. I'll now pass back to our host to continue with the summit. Enjoy the conference. Thank you.